Hey everyone! Welcome back. Today we're diving into a transformative approach for retirement planning. The bucket strategy. Whether you're a financial enthusiast or a developer curious about simulations, this video is packed with insights. Let's get started. We're diving into a full spectrum strategy to help you plan, simulate, and secure your retirement with precision. Here's a quick overview of what's ahead. Insights that matter. We begin with key takeaways. Why the three-bucket strategy is a breakthrough in retirement design and how it transforms conventional planning. What is the three-bucket strategy? Learn how dividing your retirement assets into short, mid, and long-term buckets balances risk and reward through time-tested allocation logic. Bucket strategy in detail. Will explore what goes into each bucket, when and why to tap them, and how to keep them aligned with your life goals. Live code simulation with your inputs. Plug in your own numbers, age, expenses, returns, and watch the system model decades of retirement outcomes. This is where financial theory meets real-life personalization. Get your optimized FIRE number. How much do you really need to retire early and stay financially free? We'll calculate that with precision. Lifetime management of retirement money. Follow a year-by-year drawdown plan that tells you what to withdraw, when, and from where, across different market conditions. Results and visualizations. See your future unfold in charts, projections, and risk analysis backed by data and simulation intelligence. Insights, observations and assumptions. Finally, we wrap up with design assumptions, lessons from testing, and what we observed while stress testing different retirement paths. This index sets the foundation for everything you're about to learn. So buckle in. Your journey toward confident retirement starts now. What is the three-bucket strategy? The three-bucket strategy is a smart and structured approach to retirement planning that helps you manage your savings across different time horizons and risk levels. It's especially useful for ensuring financial stability while navigating market ups and downs. Why you need to know. Protects against market volatility. You won't need to sell long-term investments during downturns since your short-term needs are covered. Ensures steady cash flow. Each bucket is designed to replenish the next, creating a sustainable income stream. Optimizes returns. Balances safety and growth, allowing you to benefit from compounding while managing risk. Customizable. You can adjust allocations based on your lifestyle, risk tolerance, and retirement goals. Bucket 1. Immediate bucket. Liquidity. Let's start with bucket 1. This bucket covers your short-term needs, typically the next 2 to 3 years. It includes highly liquid, low-risk assets like cash, savings accounts, short-term fixed deposits, and liquid funds. Its purpose? To provide quick access to money for daily expenses and unexpected emergencies. No stress, no delays. Bucket 2. Intermediate bucket. Safety. Next is bucket 2. This bucket takes care of your medium-term needs, generally from year 3 to year 10. You'll find assets like bonds, hybrid funds, corporate debt, REITs, and balanced mutual funds here. It's designed to generate stable returns that beat inflation, while keeping risk under control. Bucket 3, long-term bucket. Growth. And finally, bucket 3. This bucket is for your long-term goals. Anything 10 years and beyond? It holds growth-oriented assets such as equities, real estate, gold, and other capital-appreciating investments. The mission: long-term wealth creation through compounding and strategic growth. Raj is planning for retirement. He sets up a simulation to see how long his money lasts over 70 years. He'll need 80,000 rupees per month, with expenses rising 5% annually. To handle this, he uses the 3-bucket strategy. Bucket 1 handles day-to-day costs for the next 2 to 3 years. It grows at 6% and gets refilled from Bucket 2 every 2 years. Bucket 2 manages expenses for the next 3 to 10 years. Bonds and hybrid funds bring stability, with a 9% growth rate every 8 years. It's replenished by Bucket 3. Bucket 3 holds growth assets like equities and stocks, compounding at 11%. It's built for wealth creation far into the future, with transfers set every 2 and 8 years. Raj's model creates a cascading flow of funds, adapting to inflation, longevity, and market shifts. Based on your inputs. Monthly need of 80,000 rupees. Inflation at 5%. And expected returns across buckets. The simulation calculates your optimized FIRE number. And here it is. Highlighted it in a red box on screen so you can keep your goal on focus. This is the amount you'll need to retire at 30 based on input and sustain your lifestyle for the next 70 years. Once your simulation calculates the optimized FIRE number, you can break it down by age to understand how much retirement corpus you'd need at various starting points. We've now visualized how the 3-bucket strategy adapts dynamically. Bucket interactions, corpus needs by age, and stress-tested outcomes. This isn't just theory, it's logic-driven, personalized planning. Next up, we'll execute a web-based simulator where you can test your own inputs and visualize your retirement journey in real time. At the end, let's discuss about key insights. Time-based segmentation of assets ensures financial stability across phases. Liquidity bucket guarantees short-term expenses and avoids selling during market dips. Intermediate bucket offers protection with moderate returns for near-future needs. Growth bucket drives wealth creation to combat inflation long-term. Psychological reassurance through structured planning aids in better financial behavior. Important observations. Overweighting or underweighting the growth bucket can skew retirement outcomes. Buckets function in a replenishment chain. Growth to intermediate to immediate. Retirees often misalign their risk appetite with actual needs. Strategy works well with modular, simulation-friendly systems using rebalancing logic. Longevity and inflation expectations subtly shape bucket proportions. Core assumptions. Expense needs across time horizons are relatively predictable. Asset classes perform according to expected risk-return profiles. Investor has clarity on risk tolerance and aligns investment accordingly. Periodic rebalancing is implemented to maintain strategic alignment. Tax efficiency is considered in withdrawals and asset transfers. Inflation percentage consideration. Disclaimer. This video is for educational purposes only. Please consult a certified financial advisor before making any financial decisions. The strategies and simulations shared here are meant to inform, not replace professional guidance. Please do like and subscribe. And comment your email ID below if you'd like access to the web-based simulator for free. In the next episode, we'll discuss about asset allocation for each bucket.